Hello, everyone. Today we're presenting our group's experience in the INVE3001 trading game for Semester 1 2026. Our group BAVOPL was made up of Angelina Vo, Josh Barker, and myself, Zach Plaviak. Over the investment period, we managed a simulated portfolio benchmarked against the S&P ASX 200, applying a hybrid strategy of passive ETF investing combined with active short selling. What we're going to walk you through today is how we built that portfolio, why we made the decisions we did, and what the results taught us. Starting with $50,000 in nominal value of capital, we benchmarked ourselves against the S&P ASX 200. Our core strategy combined a passive ETF foundation with an active short selling layer. Over the investment period from the 10th of March to the 28th of March, we executed 25 trades in total. Looking at the portfolio composition on the left, we can see we split our holdings across ETFs covering global and ASX 200 equities, alongside short positions primarily in HLI and NDO to start, with a cash buffer. The chart on the right tells us the story of how this played out over time. The green line shows our long value holding relatively steady, while the red cumulative short P&L line trended downward, which ultimately dragged the overall portfolio value below our benchmark. By the 28th of March, we were sitting at $45,586, a return of negative 8.83%. So the thinking behind our strategy, we structured it around three main principles. First of all, being the passive core, low-cost ETFs, including VGS for global exposure, IOZ for the ASX 200, IEM for emerging markets, and VAF for fixed interest. These gave us broad diversification without high management costs, complemented by direct long positions in the materials sector. Second, an active short layer. We targeted stocks approaching their ex-dividend dates, where we expected price drops of at least negative 2.5%. The theory is that share prices tend to fall around the ex-dividend date as the market adjusts for the dividend payout, changing the company's overall cash position. We aim to capture that movement on the short side. Third, we were disciplined about our order types. Market orders were used for our long buys, and we used trailing stop orders set at 2.5% for the short positions to manage that downside risk. In terms of the frequency, we went well beyond the minimum of 2 trades per week, executing 25 trades across the period. We also held weekly reviews to assess positions and plan the upcoming trades.
In our initial portfolio, we invested across global equities, Australian equities, commodities, and fixed income. The Vanguard Index International Shares ETF was chosen as our main growth driver, providing exposure to developed global markets, particularly the US, and high-growth sectors like technology. The iShares Core S&P/ASX 200 ETF ensured domestic exposure, capturing returns from major Australian companies while offering stability and dividend income. To reduce risk, we initially invested in the BetaShares Gold ETF as a safe haven asset, and the Vanguard Australian Fixed Interest ETF for defensive stability. We later shifted to a high growth strategy given the short time period. We sold our gold ETF as it lacked income and high opportunity costs in a rising market. We introduced the iShares Emerging Markets ETF to increase exposure to high growth emerging economies, improving return and potential. To increase returns, we sold the S&P 200 ETF because it wasn't giving us the returns to beat the ASX 200. So we bought Woodside Energy as the oil and gas prices skyrocketed due to the war, causing an increase in energy stock. IGL Limited was for high growth driven by EV vehicles and battery demand. Ramsay Healthcare has been tipped as a high growth driver for the healthcare sector after a tough year. Overall, our portfolio demonstrates a high diversity and adaptive strategy while using ETFs for broad exposure and stocks for targeted returns, allowing us to maximize growth while also managing risk effectively.
Now let's look at how each of our positions actually performed. Starting with the short side, SKT was by far our biggest loss, coming into a negative $2,778. This single position accounted for the majority of our short book underperformance. FWD also disappointed at negative $532, and both NDO and VLS were also in the red. The only bright side of the short side were HLI and IGL, which generated small gains of around $247 and $215 respectively. But overall, the short strategy did not deliver what we anticipated. On the long side, the picture was more mixed, but slightly more encouraging. FMG, our direct share holding, was our standout performer, returning $262, and WDS also contributed modest positive returns. However, our ETF positions in VGS, IEM, and IOZ, being the ETFs, all closed in the red, which is notable given these were meant to be our stable passive core. QAU, the gold ETF, also dragged, returning negative $341, hence our portfolio rebalance as discussed by Josh. In summary, losses were concentrated in a small number of positions, most critically SKT on the short side, while our winners were too few and too small to offset them. This outcome raises an important question around whether our results reflected a flawed strategy, poor timing, or simply the randomness inherent in short-term trading, which we'll come back to when we discuss the efficient market hypothesis with Angelina.
Next, we can talk about the efficient market hypothesis, which in simple terms means that asset prices like our shares already reflect all available information, making it very difficult to consistently achieve above average returns without taking on extra risks. We can look at some behavioral biases that affected our group during our trading period. First was overconfidence, and in reflection, our group may have underestimated the difficulty of picking winning stocks and timing/beating the market, which led to excessive trading and taking on more risk than what was necessary. Next was herd behavior. This occurred when we were following what other people were doing, buying trending stocks, and reacted to market hype and panic. And in our case, this reflected in our portfolio that we were entering positions after prices had already moved. Lastly is loss aversion, which refers to feeling more losses strongly rather than gains. And in our case, closing our short positions too early to avoid further losses meant missing out on potential gains, as seen in our IGL and NDO trades. With reflection, we can see that this behavior can reduce long-term returns and lead to emotional rather than rational decisions. Now, an important question is whether our portfolio's performance was driven by skill or luck. Given our negative 8.83% return over the short period of time, it is unlikely to reflect skill, as the EMH suggests short-term results are largely driven by luck, meaning even any outperformance would be likely due to chance, with true skill only evident over a longer period of time. Next, it was very difficult to consistently outperform the AXS, which supports the semi-strong form of the EMH, in which all publicly available information was already reflected in the prices. This is shown in our portfolio, which fluctuated and genuinely matched or slightly underperformed the market rather than consistently beating it. Lastly, we observed that the market news immediately affected our stock prices, supporting the EMH. This can be observed in our SKT trade, which was based on public information about ex-dividend dates. However, the move was already priced in. Trailing stop orders meant our orders were already filled after the shares had fallen in value. Overall, this shows how difficult it was to avoid losses and outperform the market during unexpected events.